All right, here we are. This is Real Estate Bites, episode number 99. This is a special one. I got my friend Jay Slone here in the studio with me. And Jay was on the show last week, but we had technical difficulties, and we talked about OFA, and we got through most of it, I think.
Most of it, yeah.
But I wanted Jay to come back on to finish the rest of the conversation we were going to have. But Jay had not yet been to my poorly decorated office, and so he decided to come on in and have this conversation with us today. So Thanks for being with me, man.
Hey,
I appreciate it.
Thank you for having me.
And
also, congratulations on the new space, brother.
Thank you.
It's awesome to be here. You just gave me the nickel tour. Looks great. Excited and wishing you all the success, man. It's going to be awesome.
Well, I'll tell you, dude, you are one of the inspirations for me to be here today. We had talked about doing our own thing by way of businesses for quite some time before you opened up Legacy.
Yes, sir.
And then you opened up Legacy, about a year and a half prior to me doing this?
Yeah, we've almost been open a year and a half, exactly.
Right. So watching you go through that and learning a bit vicariously from you and seeing your success definitely was an inspiration for me to go do my thing. So I appreciate you, man. You have been a tremendous partner for me since we met a few years back and started doing business together. So
thank you. Really appreciate
thank you, man. So the Stroke Fest is done. Let's talk about the market.
Sounds good, man. So we left off kind of talking about OFA, and it's been something I was lucky enough to present to two different teams this week. And we're obviously talking about setting up something for your team as well as just, buyer activity has been down. And that's something that we were actually going to get into before I got cut short. But buyer activity is down a little bit, I feel, just because we're still in an inflationary market. People are still scared of what's going on with rates a little bit. And I think we're seeing a drag on that. So we're seeing about 20% less, and this is the crazy part, we're seeing 20% less buyer activity year over year in July, which is usually one of our busiest months. And we have more inventory this year, right? So you and I were talking about that. So you want to share some stats with the folks a little bit about kind of where we were last year versus this year, what they were like 400 listings last year and
Sure.
we're almost 500.
So people who watch this program know I go through this stuff every week. We're not going to go through stats at the end of this program just because this is a little abnormal, but nevertheless, I still looked up the stats this morning for the purpose of this conversation. So, I only look at Lorain County when I look at these stats, and I think I might want to do a separate stat sheet from now on for the sort of greater Cleveland metropolitan area, because Lorain County has been a bit different. Lorain County is one of the few that has grown since COVID. So prices keep going up. The activity has stayed pretty steady in Lorain County. But to your point, so this morning there were 491 single families and condos for sale. I don't look at multifamily. I don't look at doubles, triples, quads. I'm not doing commercial. I also don't look at mobile homes in the stat line. I just do condos and single family residences.
Makes sense.
So there were 491 on the market this morning. If I go back to July of 24, this time there were over 100 less. So there were 373.
So about 25%.
Yeah. Wow. 25% more listings on the market here this year. And you're seeing with Legacy, you're seeing less buyer activity. And I know you're backing that up. You're looking at nationwide stats all the time that ring true as well, right?
Correct. So, Midwest overall, just outside of our market, is also what I'm referring to. So we have a very niche market in Lorain County and Cuyahoga and just Northeast Ohio in general, because Columbus, some of the other parts of Ohio just are not doing nearly as much business based on just population size as we are. Mm-hmm. Okay. So let's just say that we're staying very active. I'm just seeing a lot less activity recently, not overall for the year. For the year, we're killing it. Mm-hmm. But July versus July last year, just looking at how many pre-approvals I did versus this year, we're down a little bit. We're down about 10 to 15% in overall buyer activity as a company.
And so, I mean, you've been pretty steady since you opened your doors.
Yes.
And growing.
We've been actually.
So not only have you been steady, but your numbers have continued to increase as you get your. Correct. So at any rate, your company itself has seen growth since day one.
Correct.
And we get into July here with 25% more inventory year over year,
Yes.
and you're seeing considerably less buyer activity. What's your take on it? Why is that happening?
I think people just are kind of fed up, you know, a little bit with everything just costing more. And that's been, you know, not just this administration's problem with inflation. I think it was the previous administration's, and it's been a problem since COVID, right? We spent a lot of money as a country on, you know, just bailout money, stimulus checks, all of that. Yeah, war, exactly right. So we've just been printing money for the last 5 years, right? 6 years. So we're now getting into the part to where that's affecting us. And it's just no matter what happens and let's have Doge cut all these things out. Well, it's not doing shit. You know what I mean? Just saying it's not. So, and it's a big problem. So I think people are starting to see like, hey, you know, I'm getting a lot less for my money nowadays. Let me just see what happens. So I think people are just kind of not really slowing down as, you know, all the way, but they're just like pausing for a second and just saying, wait a second, let's see what happens with the Fed. Because Trump, I mean, it's like a Chappelle show skit or something, man. Like he's just constantly berating Jerome Powell. If you put on Instagram or you watch the news, you'll see he's making, you know, just putting pressure on the Fed to try to cut rates because people forget, say what you want about Trump, he's been extremely successful at real estate his entire career. Mm-hmm. He knows how these pieces move. He knows how what works, what doesn't. He sees that we need as a country some type of break in something, and he wants it to be housing. Mm-hmm. So he wants it to be what we're paying for rates. So that's why the pressure's on Powell. Powell's doing the responsible thing and saying, look, man, we're still at almost 3% inflationary rate. We would have been probably over 3 if shelter costs, meaning then the only thing they say, the shelter report covers, just so everybody knows, in the inflation report, it covers what we pay for rent, what we pay for housing, but it also covers something very specific, which is Airbnbs, hotels, things we pay for when we go away. That was down quite a bit. It was down almost 4%. That drop is the only thing that saved that section of the inflation report. So it made shelter costs kind of even out. And if it wasn't for that and people not taking and spending as much on luxury items, aka vacations, hotels, Airbnbs, VRBOs, stuff like that, we would have been probably at a 3% plus inflation rate. Mm. So while Powell's saying like, hey, I'm reading all the data, I don't think we should cut rates because if it weren't for that like one thing, we might have been a little bit more in trouble. Mm-hmm. We shouldn't cut rates just yet. Let's see how the rest of this year plays out with things that we're doing. Everybody else is like, hell no, man. We want to see cut rates. We want to see lower payments. We want to see this. We want to see businesses pay less. We want to get some type of stimulus in the economy. Yep. So while somebody's playing it safe, he doesn't want to play it safe. He wants to go in. So,
and I tell you, you know, this is an argument that I've made so many times on this show. Lower rates is not a good thing for you folks out there, for you or I, for the common person, right? You know, it's funny listening to Trump bash on Powell, you know, and he talks about firing him. Well, it's not in Trump's purview to fire Jerome Powell. That's up to the board of the Federal Reserve.
And his term's not up till May of next year.
Right. But what he's trying to do is destroy his character publicly to such a degree that Jerome Powell just walks away.
He wants him to say, you know what, I'm done as of the beginning.
Had enough of this.
Exactly. I'm out. I don't need this.
So, but the thing is, you know, of course, Trump wants lower rates. He's a billionaire, and the billionaire class all want lower rates because they want all that money to be cheap, if not darn near free, right?
Part of it.
Versus, you know, your typical home buyer out there, and even if you are doing well, you know, you're an upper middle class home buyer, still the lower rates doesn't necessarily help you unless you're looking to downsize, right? Unless you're looking at, because lower rates are simply going to make money cheaper. It's going to make housing appear to be more affordable. And when I say appear, it's because, okay, so you've been shopping for a $300,000 home, rates drop 2-3 points. Now you can afford a $450,000 home, right? Based upon your monthly payment or whatever. Mm-hmm. So it feels like it's more affordable, mm-hmm. but that is also going to ramp up competition. Correct. It's going to ramp up buyer interest again. Correct. And that's going to cause prices to go up, creating an even less affordable marketplace for people.
Right. So that brings our moment full circle, which is what we were talking about, right? So while we're seeing less buyer activity, if people are listening out there, which I know your show is very popular, I would, if you're sitting on the sidelines waiting for these things to happen, you got to get in the game right now. Best time to buy a house was 5 years ago. Second best time is today. And the reason I'm saying that is that if we go back to, and you lived through it and I lived through it, and we worked through these things right after COVID and during COVID, when the rates were extremely low and there was this thing with inventory and then a super high demand. So while we have more inventory for the moment, if we do start to see rates get cut, we're going to have these buyers come out of the woodwork. We're going to have more listings come available, but we're going to have an influx of buyers by 3 or 4 times. Mm-hmm. That is going to create that supply and demand thing that is going to continue to push, to your point, loan, appreciation up more from where it's already at an all-time high, right? In Northeast Ohio, for the most part, we're setting records every single day. So we're going to see that. We're going to see competition ramp up. And what does that mean for the average home buyer? What that means is that you're going to be in steady competition. You're going to have appraisal gaps. You're going to have these issues with actually winning out there. So while, yeah, you're getting a 4.5% or 5% rate, great. Doesn't matter if you don't win. Doesn't matter if you don't get your offer accepted, and the competition is going to be fierce. So I think these are the things too that people need to hear, because it's not just like, hey, let me just get back in the game when rates are 4.5% or 5%. Wrong. You have maybe 2 or 3 people you might be competing against right now. That is going to be, double digits.
For sure. And I mean, prices are where they are because of artificial demand, right? It's because the Fed lowered rates to an all-time low, which we may in our lifetime never see again.
Correct.
And that created,
which I felt was completely irresponsible. We didn't need that too.
Well, look what it's done.
Yeah.
I mean, look what it's done.
It made our tomorrow very hard, right?
We, the people, cannot sit here and complain about a lack of affordability in housing, and at the same time, with good sense, clamor for lower interest rates. Right. It's not even, ancient history. It's very recent history that shows us that low interest rates are why housing is so unaffordable right now. And even though we have 25% more inventory year over year today, we are still, again, 6 years ago, there was 1,100 houses on the market this time of year.
Correct.
So we are still very, very low inventory. Yeah. And, the thing is, certainly in Lorain County and in many, if you have a large urban center inside of your county, Cleveland, Akron, Toledo, Dayton, the numbers are a little bit different. But if you're in these, dense suburban sort of counties like a Lorain County or a Geauga or a Lake, Medina is a great example. These prices keep going up and up and up. That's another thing that we've been tracking here on the show. The median value per square foot for last week's sales here was $181.82. Man, when I started doing this program, not even 2 years ago, so this is episode 99. I think I've missed 4 weeks with episodes. So, look at these square foot values, and I know you can't see it if you're watching out there, but when we started this program, we're looking at 150 on average, 149, 142. We're seeing all these. Yeah. The first quarter that I started tracking this median square foot value quarterly to get a real-time indicator what's going on with prices. Mm-hmm. The first one was at $148.32. So that was where are we at here? Q4 2023.
That's a great way to look at it.
The next one, Q1 24, 143.85. The next quarter it was 156.17. So that's a huge jump. That's $13 a square foot. And after that, we jump up to 161, right? So that's another $5 a square foot. After that, we dropped $1. But then after that, we went up to 165. And now we're looking at square foot values here. In this most recent quarter, you're seeing, I would say it's probably closer to an average of 173, 174. Mm-hmm. Let me see here. Where's that one at? I'll give you the average right now. The average is $170.96. So home prices, home prices continue to increase, at least here in Lorain County. Even though there's less buyer activity, even though demand has shrunk, home prices keep going up.
Yeah. And I mean, that's one thing too, is that, for the first time, home buyers are actually facing like several different things, right? So it's not just competition of, the market, it's also competition of rising rents. So we're getting pools of people that are trying to qualify and push themselves into the market right now, just because we have investors that are pushing rent prices up because of what you just said. Price per square foot. They know the market and they can get more money. And so that is really where and the unaffordability is also coming into play. So we're having the limitations that we have in the marketplace, or because of demand, is also because of that. So we have a whole bunch of renters that weren't planning on this, that were pushed in. Then we have people who naturally wanted to always buy, that are entering the pool and trying to buy when other people aren't, to try to get there. But the demand isn't there or listings for first time. We have a percentage right now of more seller activity than buyer activity, because people are trying to get the best price per square foot they can for their house and be smart, right? But these buyers are a little apprehensive. They're waiting to see what happens with the Fed. They're waiting to see, like, hey, they're putting a pause on it. And when people don't vacation, which we just saw in July, that's down. That means they're probably not also looking to buy. People are kind of just cautious right now, which I don't really know what the reason, outside of everything's just costing more. They don't want to just jump in,
Yeah, I think that's number one.
And that's kind of crazy.
Everything's more expensive.
Exactly.
So it's not just the cost of housing.
Yeah.
It's the cost of the groceries. It's the cost of all your utilities. Insurance is a killer. Yeah. Property taxes just went up considerably. Everything
20%.
Everything just
did too. 25%.
Everything costs so much more.
Yeah.
And then there are the fears, the fears of what may be going on economically. Yeah. So I definitely understand buyer hesitancy, and circling back, listen, I don't see any relief in sight for home buyers. What's your take?
Well, here's the thing, is that one of the reasons that OFA did, revamp their program is to make it more appealing and more affordable with the drop in rates, right? So we're seeing first-time home buyers specifically getting a break in that sector, or with lower rates to help them out a little bit, but only only a certain percentage qualify for that. I do think that, if this administration gets what they want, I do think that prices will go down for first-time home buyers, meaning everything that you just said, where yes, will it be tougher to get that offer accepted? Yes. But ideally there will be more inventory, because rates, if let me just back up for a second. If the replacement for Powell is Waller, which is a very bullish guy in the Fed, he's already rumored to have said, as soon as I get in, I'm going to cut rates 125 to 100 basis points immediately off of the Fed funds rate. So to translate what that would do for rates, it would literally take our 6.5-ish, 6.75% market. We'd be immediately in the low to mid fives, ideally, right? Because of what would happen with the 10-year, things like that. It would really help out. So it would translate into lower rates, whether it be high fives, high fives, low fives, whatever. Still, that would get a lot of people off of the sidelines as far as sellers go. So it can mean more affordability. That could be on the horizon, more listings on the horizon, but we still have a huge building deficit. So I think it's going to take years to fix this problem, to answer your question. And I'm no economist by any means. I just, kind of work here. But the point is that I just work and I just see it every day. I think that lowering rates would help for the short term, at least to get through it. But unless there's some type of building, plan to get more homes that are affordable, you don't see homes that are built between 200,000 and 300,000 anymore. Mm-hmm. When was the last time you saw a development in any area really outside
Pre-COVID?
of? Yeah. So we don't see the $200 to $300 price, $200 to $300K price point, which is the most saturated price point in Northeast Ohio. 150 to 300 is a killer. We were just talking about the average price point of homes that are sitting longest, and those are all still selling them really fast, right? But the homes that are sitting and driving that median average of homes, because the average time to sell a home in Lorain County is about 30 days, right?
About 30 days.
About 30 days. But
on market.
On market, from listing to sale.
No, again, so this is something I talk about also on this program. On market means this. They put the house on the market. So it's on the MLS, it's on Zillow, it's on Realtor, it's advertising. they're receiving offers, they are negotiating offers, they're coming to terms with a buyer, right? So now they're under contract, which ostensibly for most people means off market. At that point, most agents will move, if they're doing their job right, they're going to move the property from active to contingent, at which point in time, most buyers and other agents stop showing, because in this market where inventory is so tight, most of those deals keep going through, and it's not worth negotiating unless this is a house that's so special to your buyer client that they're willing to write that secondary offer and sit and wait to see what happens. You just keep moving, you just keep shopping, right? And so anyways, they've advertised, they've negotiated, they're gotten under contract, and then we got to move through the contingency phase, right? So inspections are happening, then appraisal's happening, and then we go through all that, right? And then it finally gets to you, and then you offer a conditional loan approval, and at that point it goes to pending, and that's when it comes off market. So even if we're talking about an average on market time, and frankly that average on market time that we looked at earlier of 30 days, that went all the way back to mid 2023 when I started doing this. Right. So that's not necessarily showing what's just happened in this year or even year over year. Nevertheless, at 30 days, that means they're going on the market, and all those things have happened before it comes off market. So houses are still selling quickly.
Exactly. So that is what I'm trying to say. So that heavy saturated price point is something that we really need to fix the problem. Because that's where affordability lies for middle class America, is between 100 to 300,000. We need to fix that. And I don't know what the answer is to that. And it has to come down. And I'm really shocked, that there aren't more building. Great. Lower rates help out most everybody. But again, still there's certain classes it's going to help out way more. Right. And I know we're talking about a lot of problems here, and I do have some solutions to some of these on the financing side, but unless we fix that box, we will continue to have an issue. So we either need to give building incentives to where those smaller builders can actually do a lot more for middle class America. I think that's one of the biggest issues that we have. There's no building incentives. If you did give building incentives, would they be passed on to the buyer? If they did cut costs, or you did have additional tax incentives for builders, would those be passed on to the homeowner?
Well, if it's going if these incentives are going to come from legislation, which is typically where they're going to come from,
right,
there would have to be some sort of stipulation there.
Right.
And I totally agree. I think the only relief for buyers is more inventory, which is not something that happens quickly.
No,
not even close. And then to your point, the specific sort of buyer that needs the relief the most is buying $250,000 and less, right? Where there's no good profit for builders at that price point.
Not right now.
No.
There's no margin.
So we have to create that margin. And how is it created? The only thing, and as much as, me, I'm a small government guy, as much as I don't like getting the government involved, legislation is the only thing I can think of. I mean, there's, and I've talked about this again here on the program, incentivizing communities, municipalities to relax on zoning laws, right? So that you don't have to build, a 2,500 square foot McMansion or colonial on a 100 frontage foot lot, that you can do a lot of infill development, that you can use smaller lots, that you can build maybe multifamilies inside of single family residences, because that, it's not just home buyers, it's also renters that need relief. So these things.
I think that cities getting involved with their vacant and being more involved with or paying attention and maybe holding some type of investor conference where they have all of these homes that they just have, to have investors step in, buy, renovate, and resell under certain, programs or incentives for middle-class families or families that live in Lorain County or Cuyahoga County or whatever it is. But there's a number of ways that can happen. One of the solutions that we have as a company that we offer right now is just renovation lending. So renovation lending has become extremely popular in the last year and a half. The reason, because you can buy a home that needs TLC in the 150, 175 price point that everywhere around it is selling for $250,000, $300,000, and you could put in the work. through these loans, we can fix foundations, we can add additions in bedrooms, we can add luxury features, we can add pools, we can add, we can completely do a gut job essentially. And people can make the home the way they want it to be without having to pay a $450,000 or $500,000 price tag.
With that product,
Yeah.
So are there contractors that need to be used, that need to be certified by the lender? Tell me about that. Who can do the construction, the renovation?
That's great. So in the state of Ohio, you don't even need to be a licensed contractor to do it, but your subcontractors do have to be licensed. So depending upon how much work you're actually going to do to the property, and they just increased it. So FHA made a great change this last year. So not only is and also conventional adopted it too, the streamline now is $70,000. So you can do up to $70,000 worth of work on a property without involving what's called a HUD consultant, which is basically a superintendent overseeing the job and holding your contractor accountable. Okay. Now, if you're doing bowing walls, anything structural, additions, fixing basement, stuff like that, the HUD contractor is involved from day one, or HUD consultants. Okay. So that has to be known. But you can, as long as the after renovated value, aka the ARV, is going to be more than, obviously, a lot more than the property is appraising for right now without the work, then it happens. So this is what the buyer does. They hire a contractor, they get a bid. They say, we want to do new bathrooms, we want to do new kitchen, we want to do new flooring, we want to update the house, period, finished basement. Okay, that's going to cost $75,000. We involve a HUD consultant, we get the contracting bid, we submit it as soon as we make application for the appraiser. Let's say the starting, the price point is $150 that they're buying the house for, but after the work's done, the house is going to be worth $250. The buyer only needs to put down, in most of these programs, if it's conventional, 5% down, 3 to 5, just depending on their income, on the after renovated value. Okay. And on 203Ks, you can now finance, and on home styles as well, I forgot, you can finance up to 6 months of payments. So the amount, they don't have to live in the house while this work is going on. So they could live with family, they could live in their rental, whatever, and they could finance up to 6 mortgage payments inside of the loan as well. So then they're not paying for a home that's under construction that they're not even living in yet. So there's like all these little features that they can add into that weren't relevant 2 or 3 years ago. So, the governing bodies are aware, like, hey, we know there's an inventory problem, but if you have a home in mom and dad's neighborhood where barely any sales are going on, and you could buy that home that needs some TLC and looks like crap right now, it's kind of a dump, and then put that money into it, and you're going to get a return. Like, that's also kind of something people are scared of doing. Don't be scared to do that. Every loan that I've done has, I was talking to a client this week. They bought a home out in the Norwalk area. Okay. And they literally got the home for almost $200,000 sitting on acreage. They put in about almost $100,000 worth of work. This house is about to appraise for $400,000. You know what I mean? So it's like the return is there. Sure. If you, and this is where you have to rely on a professional, your real estate agent, to walk you through, like, hey, what do the comps look like once we add this square footage? What do the comps look like once we add these amenities and upgrades?
For those renovation loans, what kind of equity do they need on top, right? So the total loan amount, that's going to be what, 75% of ARV? What kind of equity do they
That's
need
really where you max out at. So let's say we're doing $150,000 home. You can't do $150,000 purchase price. You can't double down on the amount of your purchase price and say, I'm going to put 150 on top of that, because then you're overbuilding probably for the area, and the lender's not going to take that kind of risk. But if you're trying to put in 50 to 70% on top of the ARV, they're going to be okay with that, because it's actually going to appraise as well. So, and that's where the appraiser gives us feedback, and they'll say, okay, you give us this laundry list of improvements you're making. It's going to add X amount of dollars to the value of the property. So here's your after renovated value, which most of the time it's a lot more. Like I just closed one in Westlake. They bought the home for $300,000. Home's going to be worth $425 when they're done. They're putting like $70K into it. So that's a great return.
Sure.
Like, they're walking in with a lot of equity. Like, yeah, your loan amount's all based on the actual, you're putting money down based on the, or you're starting with a way lower purchase price, but when the work is done, that's where the equity piece is.
Right.
And then a lot of people, when rates drop, are going to refinance out of them. And that's the play right now. So if you can don't get out of the game because of what's happening now, because if you think it's bad with competition now, wait till rates drop a point. If you want to gain equity, these programs are great. There could be a solution right now until the government figures out what the hell they're going to do, because they really need to fix or try to focus on this, but they won't.
And to that point, like I want to make it clear to people who may be watching this now or later. Man, I talked to so many people. I was one myself back in the day. If you think that homeownership is an impossibility because of your financial situation, it is most likely simply because you are unaware of truly your financial situation and what you need to do to get into the ability to purchase a home, right? I talk to so many people who approach me, or they just think homeownership is out of the equation, and it might be today, but it might not be in 3 months. What you need to do though is get a hold of me and or Jay, work with his team. They'll sit you down, they'll run your credit, they'll talk about what exactly you need to do and in what sequence to fix your credit rating for the least amount of money out of pocket in the shortest amount of time to get your credit score and your debt to income ratio, as well as your reserves, in line to where you can actually be prepared to purchase a home. And if you qualify, there are great programs like OFA, Homes for Heroes, things like this, where you don't need a down payment, right? You don't need a whole lot in reserves because those programs take care of it for you. But if homeownership is something you aspire to and you're just afraid you're not quite there, give one of us a call, reach out to us, sit down and go through the process of getting educated about exactly where you are and exactly what you need to do to get to that position of credit worthiness to where you can start shopping for your home. Because if we were to wrap all this stuff up in a nutshell, and it's about time to wrap this up, it's that it seems like you and I we believe that even though inventory is more than it has been year over year, even though buyer activity is down from what it has been year over year, home prices are still continuing to creep up and up and up. And if the lower interest rates that the marketplace seems to clamor for, that all the billionaire investors want, that all the big money investors want for their cheap money, if that happens, there's going to be a brief moment, like you need to act quickly. If rates drop, you need to act quickly, which is another reason why you should talk to a professional today so that you're prepared in case that happens. Either shop today or get ready for the day that it happens, because you need to be ready to go. There's going to be a very short window for you to shop and find a deal before home prices begin to escalate the way we saw them go up in 2021, 2022, and the first half of 2023. All right.
Get ready to get ready.
Get ready to get ready. There's going to be a short window to take advantage of lower rates, and then prices are just going to keep going up. So, we need more inventory. I talked to my state rep, Joe Miller, not too long ago about this thing. There's a number of bills in the state house and in the state legislature that they're looking to pass that are supposed to give incentives to builders, tax incentives. A lot of legislation is centered on, in a sense, forcing some communities to lax their zoning laws so that infill development could really start to ramp up. It's the time to act is now, folks. And if you wait, it might be too late to take advantage of whatever benefits may come in the future. So, hey man, I appreciate you coming on as always. Thank you, Jay Slone. You're one of my favorite minds and people to sit here and talk to about these things, about the marketplace. So I appreciate you joining me, man.
Hey, thanks for having me, brother. And anybody, if you need to reach out, 440-281-4608. That is my cell. Be happy to help at any time, kind of comb through what we talked about. But thanks again for having me, brother.
All right, man. All right, everybody. Thank you, guys. I appreciate you joining me. Share this with friends and family who need to see this. And as always, take care of yourselves. Take care of one another. I love you, people. I'll see you next week.
Awesome.